Hi everyone, Tony here from the mortgage agency. Today, we're going to talk about borrowing 105%. What is borrowing 105%? This is generally done when you don't have sufficient savings or you don't want to use any of your own savings because you want to keep it for a rainy day, but you have substantial amount of equity built up on your existing property. Borrowing 105% can be done with either buying an owner-occupied property or an investment property. Essentially, it means you're borrowing 100% of the purchase price plus stamp duty costs. For example, let's say you currently have a property worth $1 million, either occupied or investment property, with a loan of $500,000. The usable equity portion is $300,000. How did I work this out? Well, you got $1 million valuation, at 80% is $800,000. Minus your existing loan of $500,000 equates to $300,000 worth of usable equity. Therefore, to purchase a property for $1 million, you first need 20% deposit plus stamp duty to avoid lender's mortgage insurance. This equates to around $240,000 for New South Wales property. Now, because we've got $300,000 of usable equity, this is more than sufficient to cover the 20% deposit plus stamp duty. This $300,000 loan is secured against the existing property. Therefore, with the new property, you will just get the remainder of the 80% loan secured against that property. What is the purpose? There is a couple of reasons why you will take on this structure. You don't have the savings to cover the deposit, you don't want to use your own savings, and you'd rather keep that savings for a rainy day. You want to maximize your tax deductions. Because this is an investment property, you want to maintain the highest loan possible. Is this structure better than using your own cash? If purchasing an owner-occupied property, there isn't a right or wrong answer to this, as it all depends on personal circumstances. If the property was purchased as an investment, then yes, you would use this structure because you're able to claim the whole 105% loan as a tax deduction. The con of using this structure is your loan is going to be bigger, therefore your repayments are also going to be bigger. However, leaving your cash sitting against the offset account does allow the loan to minimize the interest charge. The beauty of this structure is you can easily pay down the loan and decrease the limit with the funds you have saved up over time if you really wanted to, with no penalty. If you're not comfortable with obtaining a bigger loan through this structure, then you could use your own cash for the 20% deposit plus stamp duty. This means for your new purchase, your loan will be smaller. Or a mixture, use your own cash or draw out the remaining equity needed for the shortfall. How do I find out if I can use this 105% structure? There is a couple of steps. You have to ensure there is sufficient usable equity on the existing property. You also have to make sure that your serviceability allows you to borrow 105%. Even though you may have more than enough equity to use on your existing properties, your lender needs to see that you have the capabilities to service the whole debt. Once again, thanks for watching this video, and I hope you've learned something new today. And as always, I hope to see you soon.